Hey, what's up guys? Chase here, and today I'm going to be going over a video on the basics of options because I am not a financial advisor, as I know you guys are certainly aware of by now, and yet you're still watching this video, all 10 of you. So congratulations for taking the time to learn a little bit about options from a complete and utter non-financial advisor. I was going to say something else, but maybe you wouldn't watch. So here's the basics of buying and calls and puts. We're not going to be talking about selling today because I want to teach you basics. So we're going to dive right in. A couple things I think you need to familiarize yourself with before we can get super far into this is three terms that I think are really important for you to understand. One is the strike. That is the price that the option you purchase is locking the stock in at. So it could be a $100 strike price or a $99 strike price or a $110 strike price. The second is the expiration date. That's how long until the option expires do you actually have the chance to see if the stock's going to go in your favor. And then lastly is the premium. That's the cost of trading this transaction, this option. So you're buying the right to purchase a stock at a future date at a set price. So for example, if you thought a certain stock was going to go up, let's just say Apple, it's trading at $130 a share right now, and you thought it was going to be at $150 in 6 months, you might buy the $140 option for 6 months from now and pay $5 for that premium because you think it's going to go up to 150, and I'll show you what those numbers look like in a little bit. So first, let's talk about call options. If you're buying a call option, you're long on the stock, and that means you think it's going to go up. That's just a fancy term that they use. You think that stock will continue to rise, so you're thinking long term. You have the right to purchase it. You do not have to. You have the right. Each option typically represents 100 shares. This is where people can get kind of confused. So if you're buying an option, it's bundled in a package of 100 typically. So your option price, you're going to multiply that by 100 to get to the cost of the option. There's always an expiration date. So that option at some point will expire, either in the money or out of the money, which we'll explain in a little bit. And then one of the questions I get asked quite often is, I don't have the money to buy the shares. Well, that's no problem. You don't actually have to buy the shares. You can typically sell the option, and there's going to be a premium attached to that. So let's just take this as an example. If you bought an option for 50 cents was the option price, and you're going to multiply that by 100 shares. I guess I should clarify that this is shares. It's going to cost you $50. Now, if it goes down in value and you sell it for $25, you just lost 50% of your money. Congratulations, you just lost. That's what a lot of people who buy options do. Some people end up making money, and I hope that you're one of those people that do. And you might be this person where it goes up to $1 as a premium. You multiply that by 100 and you end up with $100. So we'll go over this in just a second. I'll give you an example of what that is. And then puts, a put option means you're short the stock. That means you think the stock's actually going to go down. So if you thought Apple was going to, it's at 130 right now, and you thought it was going to go down to 100, you might go buy the 110, hoping that it goes down to 100 like your due diligence suggested, and you're going to make a bunch of money. So all options is leverage. You're getting the right to 100 shares of a stock for a smaller price. But there's two things you got to get right. Not only do you have to get the direction of the stock, you got to guess which way it's going. And by the way, there's 3 ways stocks go. Okay? They don't just go up or down. They can also trade sideways or flat. So you have to guess one of those 3 ways correctly. And you also have to guess it in a certain amount of time. So that's where the options get a little bit tricky. So without further ado, let's go ahead and dive into an option chain. I've got Thinkorswim with TD Ameritrade pulled up, and this is their paper trading platform. So I thought I'd show you guys what this looks like. It's really neat. I love trading in it. I obviously am not sponsored by TD Ameritrade's Thinkorswim platform. Me and my 10 viewers don't garner enough for them to pay me money. I just like it. You can trade with whatever you want, but I really like this platform quite a bit. So what we're going to look at right now is an option chain for AbbVie. That's a biotech company that I really like. They got a great dividend, and it's a pretty good growth potential stock. So right now it's trading at $109.02. You want to buy an option. You think this is going to go up, so you want to buy a call option. Let's say you think it's going to go to $130 by May of 2021. So right now we're January 2021. We think in the next 4 months it's going to go up. 4 or 5 months it's going to go up by let's see, 130 I think is what we said. So I can open the options chain. Now the way that this options chain is laid out in TD Ameritrade is that calls are on this side and puts are on this side. And this is fairly easy to read. So let's just look at the columns. So this is going to give you the last traded price for that option. This is going to give you the net change for the day. So this option right here, the 110 strike price, it went up 96 cents today. Well, that's evidence because the stock went up $1.75. So notice that just because the stock goes up $1.75 doesn't mean the option goes up that much. It's going to trade differently than the stock will trade. And let's see, this is our bid and our ask. So the bid is what someone is willing to pay. The ask is what someone's willing to sell it for. And then this is your expiration date. So these expire on the 21st of May, 2021. And then, of course, we already went over the strike price. Now, this is the puts, this is the calls. So going back to our original thesis, we thought it'd be at 130 by May. So we don't want to buy the 130 because if we go to buy the 130 and we think it's only going to be a 130 at May, I want you to see something here. We've got our break-even stock price. So it's saying, hey, you want to buy 10 options of AbbVie for a 130 call strike at $1.12. So we're buying 10 of these, not just one. So 10 times 100 is 1,000. So we're buying 1,000. Basically, we're reflecting 1,000 shares of this stock price. So just to make it a little bit easier, let's back this off to 1 so we can do a 1-to-1 ratio. We want to buy one of these. So we, again, we take 100. So one option represents 100 shares. We multiply 100 by $1.12. We get $112. This is my favorite thing to look at is this break-even stock price. So you're betting, in this case, you're betting that by May of 2021, the AbbVie will be higher than $131.12. Well, our original thesis was we think it'll be at 130. So we probably don't want to buy the 131. We want to buy maybe the 125 one. So when we look at the 125, back this off to 1, we have a 126.91 is our break even. So what happens if this goes to 130? Well, if you held it till the expiration, you have the right to buy 100 AbbVie. You got a right to buy 100 shares for $125. So anything above the 126.91 is going to actually be profit. Anything below that, if it's 126.91, you're breaking even. If it's below that, you actually lost money. So that's pretty much how it works. Now, remember what I said. You don't actually have to sell or buy AbbVie in this scenario. You can actually sell this option back for premium. So someone might have bought this particular option. Let's see if we can look at what one of these looks like here real quick. So this option chain is right here. We'll look at a 20-day chart. So you can see the last 20 days, this option is traded from $1.81 down to 79 cents, all the way up to $1.49, which is the mid right now. One thing I wanted you to notice is that there's a pretty big gap between these two numbers. We would consider that an illiquid chain. So there's not a ton of activity at this price. So the buyers and sellers are really far apart. So you could see that if you paid $1.91, you'd be paying, gosh, $80 higher for this than the lowest buyers currently willing, or than the highest buyers willing to pay. So this would be considered a liquid. It's pretty far gap. You might not want to just smash this button right there. You might want to adjust this price down. You can click on the mid. That'll actually take you, let's see, the mid is 155, so that's right between the highest purchaser and the lowest seller. It's right between those two. You can actually just go ahead and type in here. You could say, hey, I want to pay $1.20. And if you went and put that in, it would actually bump this and it'd make you the highest bidder at $1.20. So pay attention to those prices. I'd really want you to look at that. But getting back to this chart, you can see that if you would have bought this at $1.81 and then panicked and sold it at 79 cents, you lost more than half your money. So you bought it for 181 bucks, you sold it at 79, you lost $102. Now, if you would have just held on to it, you'd be back up to close to getting your money back. Obviously, if you're buying something like this with time, you really want to give yourself the opportunity for that to reach its maturity and potential. That's why you're buying the time, because you're paying a lot more money for that right to have that expiration date be later. So let me give you an example. Let's look at the same 125 strike price, but let's look at it for February. So 125 for February, it only costs $35 to buy this 125 for February. So if you think it's going to go up really fast, it's a lot cheaper to get into this. So hopefully that makes sense. Again, you're locking in that strike price of 125. You have until this date, and this premium is going to go up and down just like we showed you. We'll look at this particular strike price real quick, and you can see. Oops, where are we at? There we go. So you can see this one's been bouncing around. You could have bought it for 15 cents on the 28th of December, and now it's at 37 cents. So you could have more than doubled your money in that instance. And you didn't have to buy any shares. You could have just bought the option. So this has been the basics of options for you. I hope you enjoyed this video. I hope that you learned something from it. Go ahead and type in the comments below if you have any questions or anything I missed. Again, I'm trying to keep this video relatively short without going super deep on all these Greeks and all the other fun stuff. I don't want to confuse you. It's very simple. You have those three things we talked about. You got the strike, you got an expiration date, and you got the premium you got to pay. Then you're picking, do I think it's going to go higher or do I think it's going to go lower? And then the big thing is, if you're a beginner in options, you're always going to be buying options. Selling options is a little bit more advanced, and it can actually cause a little bit more, I guess, triumph, if you will, a little bit more heartache. There you go, that's a better word. So let me just show you. These were buy orders. It says that the max loss right here is $390. That's the most money I can lose. If I buy those, I can lose 390 bucks. And in this case, we're buying 10 of them. So we're representing 1,000 shares of AbbVie for, almost no money, right? Like 390 bucks. 1,000 shares of AbbVie would be 100 grand if I wanted to buy those. So I'm getting the movement of $100,000 worth of AbbVie for only 390 bucks. But obviously, this is a very, very high risk play, because for this stock to go up that much in that short a time, it'd be very, very, very unlikely. So let me show you what a sell order looks like. If I went to sell this and I don't own the stock, so that's called a naked, it'd be a naked call. I would sell a naked call, naked because I don't have any shares. It'd be a covered call if I own the shares. If I went to sell this, I want you to see what your max loss is. Infinite. Well, why is it infinite? Because this stock could just cure cancer in a freaking electric vehicle car, and and all the while it's redesigning genes through CRISPR or something. Like this thing could go to infinite possibilities. It could go so high that you could lose your shorts. So that's why it's infinite. So we're not talking about selling today. We can talk about that another day. But just so you understand, look at this max loss on whatever platform you're using to trade. Check this max loss out and see, like, am I buying or am I selling? Make sure there is a max loss and it's not infinite. Otherwise, you could get yourself in a real risky situation. Like, imagine if you were to sell Tesla in April of 2020 and that thing just keeps going and going and going. I mean, people that did that, which I'm sure there was some, have probably still reeling from the pain. If you're one of those, I apologize. So again, if you like this video, go ahead and smash that thumbs up button. Obviously, we'd love to have you subscribe for future videos just like this. And if you have any comments on any questions or anything I missed, I'd love for you to share that with the audience of 10 or 20 or 21 people. That would be amazing. Thank you guys so much for checking this out. Have an awesome trading session. And be careful with options. They are very fun and you can make a lot of money in a very short period of time. And they often expire worthless. In fact, I think the majority of them, like 75 or 80%, expire out of the money and people lose that money. If you buy stocks, as long as the company doesn't go bankrupt, they'll be worth something, which can obviously happen, but all options are destined to expire. So be very careful when you're trading out there. Thanks for watching this video, guys.